Hello folks, I'm L.A. Little and this is your weekly NeoTA wrap. We take a look at these markets and we do it from a neoclassical perspective. Each week we ask ourselves what happened last week and what does it tell us about the coming one. I do a show every Sunday night, broadcast at or before 10 o'clock Eastern Time. It's archived on YouTube. It's under the channel L.A. Little. You can catch it there. It's available anytime, anywhere, any device. As far as what happened, well, as we all know, we had a sell-off last week, and then we had the proverbial rally that always seems to take place in these markets to cut the losses quite a bit. Ended up down a little over 0.5%, 1.3% on the Russell, minus 5% on the year in the Russell. Russell's on the verge of trying to break down. Not that much, losses here yet, but for the most part, the markets keep holding up, even though there continues to be pressure near term. Looking at these markets, let's take a look at the indexes themselves and see what we have here. So, if I pop over to, if I can. Yeah, sorry, bear with me just a second here. Didn't quite have this ready. All right, here we go. So S&P 500. All right, so last week we're going to start looking at the daily and then we'll pop over to weekly. Last week we come down, just kind of barrel down here, get into this lows high, and then turn around on a reversal. This bar, nice big reversal, less volume, under, back over, finishes off the ABCD structure, back to the upside. All good and well, gets the bounce. Now it's coming back up to test this breakdown bar. If it gets over the breakdown bar, then it will go for the next one. That's kind of this scenario that we have set up here. What does that say? It says, well, there's potentially a big range. The smaller range is the one that's here. The larger range could be these lows, all the way up to these highs. I suspect that somewhere in there is the range. That's where it's going to try to trade out. And I also suspect that with earnings season just around the corner, that's probably going to be the next catalyst unless we get some sort of a big move off of geopolitical, like Hong Kong or some other place. We still got the Russian situation in Ukraine, although it's a little bit of the back burner anymore. But it's still a problem because there's still sanctions. There's the potential for more. There's a potential for Russia to retaliate with sanctions again. That whole escalation has been continuing. Same thing with the Middle East with ISIS. ISIS pounding bordering towns of Turkey now. Is Turkey, a NATO member, going to get involved? That's a problem. So over and over, we're seeing more and more issues geopolitically. We got the earnings coming up, and we have some near-term pressure. I could easily see, just as you can, another ABCD structure potentially forming here, taking us lower again. I could also see, conversely, an ABCD structure pulling back and taking us higher, up to these levels. So it just depends on how this plays out. And right now, it's too early to know that, given the setups that are out there. What we do know is there is pressure. We're seeing transitions of trend. We're seeing more and more longer term trends being tested in the intermediate term time frame specifically. We've already got a break on the Russell. We've got breaks on many of the sectors, and so a lot of that's happening, and all of this happens with a push up in volumes as we come back. This is the S&P 500. You can see to break on an intermediate term time frame, you'd have to get down to the 1904 area. We got as low as 26. It's not that far away if this market starts to roll over again. Potentially will do so because as it hit this high, 1942.92, it had more volume. So it pokes into the highs of the lows, more volume. That's a strong suggestion that it's probably going to come back at some point. So that's kind of the big picture looking at one of the stronger ones. If we go over to the Russell, same sort of scenario, everything looks the same, just weaker. the Russell is coming back up now, and this will be one of the tells this week. On a daily, it's coming back up to do a retest, regenerate off the prior break. It got into the lows on Friday. So far, it's got just about the same amount of volume as it comes back. We got 378 there. You're coming into it with 356. So you come in with a little lighter volume. You go into it. You fail. Come back. That looks like a regenerate lower attempt. We'll know that more by the time we get out till by the time we see some trading this week. So an attempted retest, regenerate to the downside on the Russell on the daily. Here's the Russell on the weekly. You can see the trend change. So now you've got a trend change here. You've got lows that were broken there, and you've got all these other ones still lined up to break. If the Russell starts to come back down and starts to break, right, then it's going to be a more serious situation. Now, given the fact that it already came down on a fast escalation to the downside, there's probably a pretty good chance that this thing tries to work sideways for a while. And if it can't lift, then you have to expect more potential downside. But that's going to take a while to play out. I don't think you're going to see that this week in particular, but that is the risk that the Russell keeps broadcasting to you, to me, to everybody. So that's kind of a big picture on the indexes. On the sectors, you know, you're starting to see more and more deterioration. If you come in here and you look at the trends as they line up, right, you can see the deterioration that's been taking place. You're bearish pretty much across the short-term time frame, almost across everything. You're starting to see breakdowns like this on the Russell. You've already got bearish on the XLE, which we have a question about tonight and we'll tackle. Sideways on a couple more. Folks, this is, you know, you're starting to see enough of these break to where more than likely we're going to see more of them break as we go forward. So given all of that, you know, a quick summary for the week is you have to expect more pressure to the downside to develop. Will it be this week? Will it be next? That's not clear. What is clear is that there is some potential for further follow through to the downside, and you have to expect that and respect that, because that is the potential out there. Moving over to the world markets, it's a little bit different. It's not quite as negative as it was last week. So if I pop in here and look at these, there are some that are worse, some that are better. The ones I want to highlight, European stocks really got hammered off the Draghi news on Thursday. They couldn't catch a lift. You can see the big downdrafts there. Over in Asia, you're starting to see kind of the last attempt to turn this thing under, back over, less volume. That's in the 8 shares for China. If you look at Hong Kong, even with the demonstrations, same thing, less volume, under, back over. If I look over at the Nikkei really got hammered hard, under, back over. So I can see bounce attempts setting up over here. But if you look at these on a longer term basis, these are ugly. Here's the Nikkei, goes up, fails at the top on the weekly, comes off, volume expands, wide price break bar. That sort of action can get you more downside over time. And then you can look at other countries like, you know, the Toronto Stock Exchange that is in a world of hurt in terms of the way it's acting. A big push down on the weekly, breaks multiple swing points. And that's true here. It's true in, say, Brazil, for example. Anything tied to the Chinese resource quagmire, if you will, is getting hurt and hurt bad, and that probably is going to continue. And a big piece of that is associated with the currencies, which we're going to delve into here in a second. So, in summary, weekly views support some sort of consolidation, choppy trading action this week, and then after that, I expect it's all going to be about the earnings unless we get some sort of geopolitical event that drives us lower. So the earnings are going to be set up. Those really start in about another week. So that to me is the setup that I'd be watching This week is really just in preparation for those earnings setups. So having said that, I want to take and switch over to a different thing, and that is the currencies themselves. And I kind of pulled some statistics earlier today. You know, and you've heard me say multiple times that fast moves in currencies usually cause problems for stocks. And I've said that without, you know, giving any reasoning behind it. But that to me, you know, is something I've seen over and over the years, and it's something to be aware of. You know, the bond market's about 2/3 the size of a stock market. The stock markets, the world stock markets, and that's in the U.S., the world stock markets trade at about $500 billion per day. Currency markets trade $4 trillion per day. So you can see the relative size of currency, bond, and stock markets, and you can see the volumes huge here compared to there. I mean, just huge. So when these things move, they can have ripples. And what kind of ripples can they have? Well, the big ripples have to do with, you know, a fast move. So in other words, if I look at, for example, if I look at what has happened here recently, and if I just kind of throw it in here as we go, the dollar has been up 8.5% in the last 3 months. And so if I pop in and I show you a chart, and I don't see any end to this, but if I throw up the chart of the dollar and we take a look at it and we pull over, you know, that's the daily. And if you look at the weekly, you can see the huge move in the weekly. I mean, just straight up. And if you pull in the monthly as well, these moves are not small. These are gigantic moves. And the dollar now is up here testing, breaking on a monthly time frame, the swing point highs. Folks, if it gets over this, there isn't anything to stop it. Now, I don't think it can keep going at this pace, but this has an equal or an equidistant range above it. It looks to me like it's going to top out here this month in this area, get some sort of a retrace, and then potentially try to attack the higher area. The last time we saw this was 2008, where we saw this kind of a, you know, fast move, was 2010, and we had problems in 2010 if you remember, and in 2008 we saw the same thing. Now 2010 led to a crash of the dollar. In other words, it came right back down. In 2008 we had the same situation, but in 2008 the fast move, given everything else, led to the crash in the markets. These fast moves do cause problems, and they cause problems over and over. Even though this one's going to take a break, could maybe lead to some sort of fourth quarter rally in the stock market, you know, if it takes a break, but it doesn't look like it's done, and it looks like it's going to come back again. Now, the reason these things cause problems, right, fast moves, is that anything that you buy, right, from us, if you're overseas and you buy from us, you're importing, or excuse me, the other way around. Anything that let me try to state it again here. I've got two different sides of this I wanted to tackle, and I was tackling the wrong one first. It makes, what this means is that it makes any U.S. good that's sold overseas 8.5 more times expensive than it was on average. Now that's, you know, going to be different depending on specifically where it's sold, but essentially it's an 8.5% tax on U.S. goods. So stocks become 8.5% more expensive. You know, anything that's made and shipped overseas, 8.5% more expensive. Any of the things sold overseas, when they're converted back into dollars, they lose 8.5% of their value. So if I'm a company like you know, McDonald's, and I'm selling overseas, if I'm not doing something about that currency and I'm not converting it real quickly back, I'm going to lose that much money on the trade, and that's a huge margin. I mean, some of these margins aren't even this large in these companies. So you can see how it can wipe out your earnings in a hurry. That's one of the things you're going to be wanting to watch when earnings come out in the next couple of weeks. Conversely, if you turn this thing around, it also goes the other way. Anything overseas that you buy is 8.5% cheaper. So any imports now become a lot cheaper. So we can buy more things from others for less money. We just print a piece of paper, stick a dollar stamp on it, and we get 8.5% more than we used to. That's a big boon for us that are doing imports, but it also applies to other things like stocks, right? So if I go back to a chart, let me pop back over here to an overseas chart. And if I look at some of these overseas charts, why do they look like they look? Well, because we're looking at them in dollars, and what I want to do is pull up some of the ETFs, and it doesn't look like I have any handy. Let me just type one in. So if I put in like say EWZ, right, the Brazilian market. Well, if I can get it in here, let's try again. So EWZ. So the Brazilian market, because this isn't doesn't have any kind of currency equalizer, you can see this dropped, let's just do a quick calculation, from 80.5 down to 38. Folks, that's more than 50%. Okay, a 50% drop in the monthly chart on the EWZ. Now if I go, and that's since 2011. Now let's go look, that's the EWZ. Let's go look at the Brazilian index itself. Okay, 2000, what was it, 2011? Here's 2011, the same time frame. Has it dropped 50%? No, it's going down 10,000 off of 62. So maybe it's going down 20%. The huge difference, part of it's dividends, part of it's currency. And even here, I mean, the currency is even worse because the Brazilian currency's, you know, even it's a different, you know, I said on average because that's the average, but you can see the huge difference. And if we just did the last month, 57 to 52, so you lost 5%. I mean, what is that, 10%? 57 to 52, it's 5. It's less than that, it's about 7. Whereas, you know, a lot of that is just the currency itself. And so the point is that a lot of these ETFs are going to give you trouble because the stocks are going to get hit if they're not somehow hedged with the currency. Now one that is hedged with the currency, look at this one. This one goes the other way. DJX, let me get DJX up. If I look at, or DXJ I guess it is, if I can remember correctly here. Let me pop something up so I can get back to the symbol. DXJ, right? This is the currency hedged one. Look how fast this came off when there was talk of the yen actually going up. I mean, it didn't go up, but they were talking about forcing it higher. And because this one's protected, quote unquote, it got hit because they were on the wrong side of that trade, right? Because this is managed to try to equalize the currency moves, and they didn't move fast enough, and it actually took a big hit. I mean, that's a significant hit. 3, 4, it's about 8% in a short, what, 3, 4, 5 day period, all because the currency moves. Currency moves, and the problem here is that when these kind of things happen, can you imagine if you're a big fund, you're heavily invested in this, and you start taking a hit, and you're doing all this on huge margin? What do you got to do? You got to go sell something else. That's the way these things work. That's why these fast currency moves can crimp stocks, can really pressure them in larger ways because people are not properly positioned. A lot of these big firms, institutions, are running huge margins, right? They're margining up 20% sometimes. I mean, not 20%, but 20 to 1. And so you're putting up $1 and you're holding 20%, 20 times that dollar. A small move, right, that's large in percentages can just all of a sudden go 20 to 1 against you in a very short period of time. And if I'm a fund manager, I either got to start dumping this thing as quick as possible or dumping everything else as quick as possible just to meet my margin calls. That's why they make a big impact on the stock markets. They're much bigger. When they move fast and they move directionally. And the leverage that people put into these things can get them hurt in a lot of these instruments. Okay, so I think that's it for tonight with respect to that. Let's take the member questions here next. Let me see, I had some poked in here. It has to do with oil again. We've seen a big move down in oil, and I'm going to pop up the oil chart first. And I'm going to put up a monthly chart and look at it. So you've got this wide trading range that's been going on. And so even though it has come down quite a bit here, it still hasn't even gotten to the swing point low on the monthly. No volumes to speak of in the US, in the OIL, which is the oil proxy ETF, right? But this whole range is in play. And it's trying to get down to the bottom end of that range. First, it's going to have to attack this swing point low. And there is some decent volume there, so we'll have to see if it actually picks up any volume or not to break it. So that's the first picture. The second, if we bring it in and look at it on the weekly, it is coming after those swing point lows, and here the volumes look about the same. And then we pull it in on the daily. It tested under, back over on the daily. That, although it did break swing point lows again, that does say this thing can finally try to bounce again tomorrow. That's the oil. Now the question is what is the impact to those things that are, tightly coupled with oil, in particular OIH and XLE, the stocks? Well, in the stocks, you don't have the test yet. On the daily, you have high volume, no test. This says it can test lower, potentially test lower tomorrow. Here on the weekly, huge volume expansion. This, folks, isn't going to stop here. In other words, even if we get the bounce and we come back up, what is it going to do? It's simply going to set up some sort of a retest regen with whatever it's broken. In this particular case, it's broken here, so that if it comes back immediately this week, that's going to be the retest regen area on this week. And so if I look at this, this high, let me get the price point on it, is 49 and a quarter. Big volume. This is going to come back again. It's not done. If I look at the XLE, now the XLE is not the drillers. This is the big processors, integrated oils. They do drill, but they've got a lot of reserves. But they have a lot of other activities going on as well. This is the XLE. Big companies like ExxonMobil, Chevron, Occidental Petroleum, so forth. Big volume spiked below, hasn't tested it. That can test it as well. You can see a trend transition here. That's on the daily. Weekly, same sort of scenario. Big volume, looks just like the OIH. Gets underneath here, trying to get down into this one. They're not done. They're oversold. They should bounce, but they're going to come at it again. If you're looking for trades, the trade is on the daily and it's on the bounce. So you have to get an under over, a 2-bar reversal after an extended move. So if it came down, say tomorrow, got underneath here, flipped around and tried to come back up, that would be the place that you could grab some and look for a bounce that would do the test on the weekly. That's what you're looking for. In this particular case, you want to get it low enough, like in, here on the XLE, 8678 is the low. If you got down to say 86, 60 or something, and then you come back up and you can grab it, then you can turn around. You can put a stop just up underneath there. So you put your stop just up underneath wherever it stops at. And what you're shooting for initially is this bar, and if it gets past it, the bottom of the next one, right? The high volume bars. That's a decent trade because when it bounces, it's going to be a violent bounce back up. But you've got to get the setup. You got to wait. You got to get a setup. And you got to have a tight stop, and you got to live by that stop in case you get stopped out. Because these things can go lower, as I just showed you on the weekly. They're not done. They can go lower. You know, it's just not over yet. So bounce, yes. Investment, not yet. The only way you're going to get the investment is let these things wash out, let them get down here and test something, fail, come back, test it again, then you can get the investment. Okay? All right, that's it for this show, for the weekly. Thank you for joining me, and I will see you next time. Have a great one.